Silver didn't just go up, it repriced. Hard, fast, violently. Multi-year resistance levels didn't get tested. They got shattered in days. Overnight moves erased weeks of range like they were never there. Capital didn't rotate politely out of paper promises. It forced its way into physical assets. Gold, commodities, and silver especially. If you're watching silver right now, you're already ahead of most fund managers. And that's not because you're smarter, it's because you're looking where they aren't. Most people think they understand why silver's moving. Geopolitical stress, inflation hedging, monetary fear. That surface story is obvious. Everyone sees it. CNBC covers it. Twitter repeats it. But underneath that narrative, something else is happening. Premiums are diverging. Inventories are quietly draining. Lease rates are ticking up inside settlement systems most traders don't even know exist. The move you're seeing on the chart right now, that's the last signal. The first signal already happened. Quietly. In places most people never look. Your job isn't to chase headlines, it's to understand the pattern before everyone else panics. So let's slow this down and walk through what actually matters. Real quick, if this kind of pattern recognition is why you're here, make sure you're subscribed. This is what we do. We track what others ignore. We build a group that doesn't get shaken out when narratives flip. And drop a comment while you're here. Are you actually watching silver, or are you just seeing headlines? Now, silver's hovering near record highs, mid-30s per ounce depending on your market. That's a 40 to 50% move in under 6 months. Gold is up too, but silver is outperforming, and that compression in the gold to silver ratio, that's a tell. But the headline price isn't the whole story. What matters is what happens when you try to buy physical metal. Premiums, the amount you pay over spot for coins or bars, are rising faster than spot itself. Delivery times are stretching. Some dealers are limiting order sizes. Others are out of stock entirely on popular products. At the same time, registered inventories on COMEX, the silver actually available for delivery against futures contracts, are thinning. Not collapsing, not dramatic, just steady, consistent drains. And those add up. Lease rates, which are basically the cost of borrowing physical silver inside professional settlement systems, are ticking up too. Quietly. In the background. That combination matters. Because this isn't a fast money, momentum-chasing rally. This is allocation pressure. Real flows. The kind driven by fear, hedging, and industrial demand all hitting at once. And those kinds of moves don't unwind cleanly. Let me give you a framework for this, because once you see it, you'll recognize it again and again. I call it the safety valve break. Financial systems absorb stress the way a sponge absorbs water. Policy uncertainty. Geopolitical tension. Inflation creeping higher. Debt piling up. Markets wobble. Volatility spikes. But the system holds. It absorbs. Until it doesn't. When confidence in paper promises starts to erode, currency stability, bond markets, counterparty risk, it doesn't trickle into alternatives. It forces its way out. Think of a steam pipe under pressure. The valve holds, and holds, and holds. Then it snaps, and all that pressure rushes through the smallest available exit. Silver is that exit. The physical silver market is tiny. We're talking maybe $50 to $60 billion in investable above-ground stock. That's smaller than a single mid-cap tech company, smaller than one busy weekend of treasury issuance. But silver is real. It's industrial. It's monetary. It has 5,000 years of history as a store of value. And it's physically constrained. So when even a fraction of institutional capital, sovereign funds, family offices, large hedgers, decides to rotate into hard assets, silver doesn't drift higher. It gets hit. A small pipe trying to handle a fire hose. And here's the key point. This pattern repeats. Every cycle looks different on the surface, but the structure underneath is the same. Stress builds, trust erodes, capital probes for exits. Silver becomes a pressure point. Price doesn't grind, it reprices. Sharp moves, gaps, momentum that feels uncomfortable to watch. Then it can reverse, or consolidate violently, or rip again. I'm not telling you what happens next, I'm showing you the structure so you recognize it when it shows up again. Because it will. Think about this for a second. The move everyone talks about, the breakout, the chart, the price spike, that's the visible part. The mechanism that drives it stays hidden until it's too late to position calmly. That brings us to the second pattern, and this one's easier to miss. I call it the quiet rationing phase. Before shortages hit the news, before premiums explode into double-digit percentages, before politicians or commentators start using the word shortage. Access tightens. Not everywhere, not all at once. Unevenly. Some dealers have inventory, others don't. Some products are available, others vanish. Delivery times quietly stretch from days to weeks. Order limits appear. Not because of policy, but because of reality. Wholesalers prioritize long-term clients, mince slow production. Institutional buyers lock up supply through forward contracts retail never sees. Most people miss this phase entirely. Why? Because spot price doesn't reflect access, it reflects the paper price. Futures, ETFs, derivatives. But when you actually try to buy physical silver, you pay a premium over spot, and that premium tells the real story. In a normal market, maybe $2 to $4 over spot for a standard coin. In a stress market, $6, $8, $10, sometimes more. And here's the important part. Premiums rise before spot explodes. They're the early warning system. Put yourself in a dealer's shoes. You've got 10,000 ounces in stock. You normally sell 500 a week. Suddenly you're getting 2,000 ounces worth of orders. Your suppliers are back-ordered. Refinery lead times double. Shipping delays stack up. You don't announce a shortage. You raise premiums. You limit orders. You ration quietly. Most buyers don't even notice. They see spot climbing and think they'll wait for a pullback. By the time that pullback comes, if it comes, the premium is already baked in. Or availability is already gone. That's why this phase matters. And it looks like we're entering it now. Not everywhere. Not universally. But the signs are there. Retail premiums widening. Inconsistent delivery times. Certain products allocated, while others remain available. This isn't a crisis. It's early stress. And most people don't react to mechanics. They react to headlines. They wait for the viral tweet, the breaking news banner. The talking head saying, silver shortage confirmed. By then, positioning's already done. That doesn't mean this can't reverse. Premiums can collapse. Demand can evaporate. Markets can flush hard. This isn't prophecy. It's structure. Human behavior repeats. Institutions move first. Retail sees price last, so circle this. Access tightens before panic. If you're watching flows instead of headlines, you're already in the informed group. Now here's the part most people get wrong. The biggest risk right now isn't buying the top. It's misunderstanding the phase. Because there are three ways this plays out, and how you respond depends entirely on which one unfolds. One path is a cool-off. Premiums stabilize. Spot pulls back 10 or 15%. Inventories refill. Fear unwinds. We grind sideways for months while everyone forgets why they were excited. That rewards patience. It punishes leverage and emotion. Another path is a slow grind higher. Premiums stay elevated but don't explode. Spot climbs, consolidates, climbs again. Institutional flows continue. Industrial demand holds, no panic, just pressure. That rewards long-term holders and frustrates people waiting for fireworks. The third path is volatility. Premiums spike. Availability vanishes. Spot rips 20 or 30%, crashes, then rips again. Headlines scream. Retail floods in and gets shaken out. That rewards people who positioned early without leverage and destroys late chasers. I don't know which path we're on, neither do you. Neither does anyone, no matter how confident they sound. What I do know is this. If premiums keep widening, inventories keep draining, and lease rates keep ticking up, then we're not in the calm part of the cycle. And the real question isn't whether to buy or sell. It's whether you understand what you're watching. Because if you don't, the next volatility wave will shake you out whether you're right or wrong. So here's what I'm watching. Not predictions. Not advice. Just signals. I'm watching how fast retail and wholesale premiums diverge. Speed matters more than level. I'm watching inventory trends, not single-day moves. I'm watching the gold-to-silver ratio for violent compression versus steady movement. I'm watching lease rates and backwardation, not for one-day blips but for persistence. And I'm watching industrial demand headlines as confirmation, not as the cause. If you're trading, respect the volatility and the risk. If you're stacking, accept that pullbacks are noise. If you're on the sidelines, don't chase narratives. Watch mechanics. And always keep the other side of the trade in mind. Premiums can collapse. Supply can refill. Demand can disappoint. Liquidity shocks can force selling everywhere. That's not fear. That's discipline. Because price moves loud, positioning moves first. If you're watching premiums, inventories, lease rates, and access, you're already ahead of the people staring at charts alone. Silver doesn't break gently, it reprices violently. Stress builds, trust erodes. Capital forces its way into the smallest exit. Access tightens before panic. Premiums rise before headlines. Can this reverse tomorrow? Yes. Can we grind sideways for months? Yes. Can we spike, crash, and spike again? Also, yes. I'm not telling you the future. I'm giving you the structure so you recognize it next time. That's the edge. Drop a comment and tell me what signal you're watching this week. Premiums, inventories, the ratio. And if you've lived through previous silver cycles, share what you learned. Access is the first signal. Price is the last. If you are early, you won't feel early. You'll feel uncertain. That's how being ahead usually feels. Stay sharp. Watch the mechanics. I'll see you in the next one.